Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas.
And I'm Lana Chen. Today we're breaking down one of the giants of global finance, Morgan Stanley, ticker MS, ranked number 38 in the S&P 500.
And Lana, this is one of those names that has completely reinvented itself over the last decade. When people hear Morgan Stanley, a lot of them still think old-school investment bank, big trading floors, deal-making on Wall Street. And yes, that's still part of the DNA, but the company has shifted dramatically toward wealth management.
Exactly, and that shift is arguably the most important transformation story in big bank finance over the past 10 years. So today we're going to unpack everything: the business model, the numbers, the strategy under new CEO Ted Pick, and where this stock goes from here.
Let's set the stage. Morgan Stanley was founded in 1935, born out of the Glass-Steagall Act, which forced the old J.P. Morgan Bank to split its commercial and investment banking operations. The investment banking side became Morgan Stanley.
Headquartered in New York City, employing about 83,000 people worldwide. And the company operates through three main business segments. The first is institutional securities, which is your traditional Wall Street franchise. Think investment banking advisory, equity and fixed income trading, capital markets. The second is wealth management, which now generates the largest share of revenue. And the third is investment management, the asset management arm, running money for institutional and retail clients.
And the market cap right now sits around $267 billion, making it one of the largest financial institutions in the world. Under CEO Ted Pick, who took the reins on January 1st, 2024, the firm has been doubling down on the strategy that his predecessor James Gorman set in motion.
Ted Pick became chairman on January 1st, 2025, consolidating leadership. He's a 35-year Morgan Stanley veteran, mostly from the institutional securities side, but he's been very clear that wealth management is the future of this company.
All right, Lana, let's dig into the numbers because the 2025 full-year results were impressive.
They really were. Total revenue for 2025 came in at $70.6 billion, up from $61.8 billion in 2024. That's a 14% year-over-year increase. Net income hit $16.9 billion, up from $13.4 billion the prior year, a 26% jump.
And diluted earnings per share came in at $10.21, compared to $7.95 in 2024. That's a 28% gain.
The return on tangible common equity, which is the metric Wall Street watches most closely for banks, came in at 21.6% for the full year. And in Q3 2025 alone, they hit 23.5% ROTCE, which was a record.
The efficiency ratio was 68.4%, meaning for every dollar of revenue, about 68 cents goes to operating expenses. That's solid for a firm of this size.
On the capital side, the CET1 ratio is 15%, well above the 11.8% regulatory requirement. That gives them over 300 basis points of excess capital. And they're putting that capital to work. The board authorized a $20 billion share repurchase program and raised the quarterly dividend to $1 per share, an 8% increase.
Let's zoom in on the wealth management business because this is really the crown jewel.
Absolutely. Wealth management generated $31.8 billion in revenue for 2025. Total client assets across the platform reached $7.4 trillion. When you combine wealth management and investment management, the firm oversees roughly $9.3 trillion in total client assets.
And the growth in net new assets has been remarkable. In Q4 2025 alone, they brought in $122 billion in net new money. For the full year, over $350 billion in net new assets flowed in.
What's particularly interesting is where those flows are coming from. About $100 billion in 2025 migrated from the E-Trade and workplace channels. Morgan Stanley at Work, their corporate benefits platform, now reaches 40% of S&P 500 companies. These are sticky, recurring relationships that generate fee-based revenue.
And they crossed a huge milestone in 2025, surpassing $1 trillion in individual retirement account assets under management.
The pre-tax margin in wealth management is running around 29 to 31%, and management is targeting 30% on a sustained basis. This is what makes the wealth management transformation so powerful. It's high margin, recurring revenue with much less volatility than trading.
Now let's talk about the institutional business, because that had a monster 2025 as well.
Investment banking revenue surged 44% year over year in Q3 2025, hitting $2.1 billion for the quarter. The M&A advisory business has been particularly strong. Morgan Stanley advised on some landmark transactions, including Alphabet's acquisition of the cybersecurity firm Wiz, Confluent's sale to IBM, and Meta's joint venture with Blue Owl.
Equities trading was also firing on all cylinders. Revenue jumped 35% year over year in Q3 to $4.12 billion. The fixed income business has been recovering as interest rate volatility created opportunities.
One point worth emphasizing is that even though institutional securities is the more cyclical part of the business, Morgan Stanley's strong positioning in technology and healthcare M&A, especially around artificial intelligence deals, gives them a structural tailwind. AI-driven transactions are becoming a major revenue source.
One of the most fascinating strategic moves is Morgan Stanley's push into digital assets. Talk to us about that.
This is a first-mover advantage play. Morgan Stanley is preparing to offer cryptocurrency trading to E-Trade clients in the first half of 2026 through a partnership with the fintech firm Zero Hash. On top of that, they're developing a proprietary digital asset wallet to serve as custodian for clients' digital assets.
So they're not just saying you can buy Bitcoin, they're building the infrastructure to hold and manage crypto alongside traditional portfolios.
Right? And when you have $7.4 trillion in client assets and over $1 trillion in retirement accounts, even a small percentage allocation to digital assets represents enormous revenue potential. They're positioning themselves as the trusted institutional gateway for crypto, targeting wealthy clients who want a unified view of their traditional and digital portfolios.
That's a smart play given where the regulatory landscape is heading. How does Morgan Stanley stack up against the other big names?
Relative to Goldman Sachs, the differentiation is clear. Goldman remains primarily an elite investment bank and trading house. Morgan Stanley's wealth management franchise gives it a recurring revenue base that Goldman simply does not have. Wealth management alone generated $31.8 billion in revenue, which is a massive competitive moat.
What about JP Morgan?
JP Morgan is a much larger institution overall with nearly $2.8 trillion in assets and significantly more diversified, including a massive consumer banking franchise. But in capital markets and wealth management specifically, Morgan Stanley punches above its weight. Their capital markets revenue growth was 24% year over year versus JP Morgan's 18% in Q3 2025.
And against Bank of America?
Morgan Stanley has a more focused business model. While Bank of America is a diversified bank with retail deposits, consumer lending, and corporate banking, Morgan Stanley concentrates on high-margin capital markets and wealth management. Their wealth management pre-tax margin of 29 to 31% is generally higher than what Bank of America achieves in their comparable segments.
Let's look at the stock. Where does it trade today, and what's the market telling us?
The stock has had quite a run. Over the trailing 12 months, it's returned about 35%. The 5-year total return is over 83%. Year-to-date in 2026, however, it's pulled back about 13%.
The PE ratio sits around 16.5 times earnings, which is a bit above the banking sector average, but reflects the higher quality earnings mix from wealth management.
The price-to-tangible book ratio is approximately 3.9 times. That's a premium to historical averages and to most banking peers. But when you're generating a 21.6% return on tangible common equity, the market is willing to pay up for that return profile.
Book value per share is about $63, tangible book about $49. Tangible book value has been growing at roughly 10% annually over the past 2 years.
Analyst consensus has 11 buy ratings with an average price target in the $192 to $196 range. The high estimate is $221, the low is $148. So the street generally sees modest upside from current levels, which makes sense after the big run.
Let's lay out the bull case. What are the big growth drivers from here?
Number one is the continued growth in wealth management. The firm is targeting $10 trillion in total client assets, and they're currently at $9.3 trillion. That target looks achievable within 2 to 3 years, driven by net new asset flows, market appreciation, and the E-Trade channel.
And the E-Trade integration is really starting to pay off.
Massively. E-Trade brought millions of self-directed brokerage accounts into the Morgan Stanley ecosystem. Now they're converting those clients into higher-value managed relationships. That workplace channel alone contributed $100 billion in migrated assets in 2025.
Growth driver number 2 is digital assets. The crypto trading launch on E-Trade and the digital wallet infrastructure position them for what could be a multi-year adoption cycle.
Number 3 is investment banking recovery. M&A activity globally is expected to accelerate in 2026, driven by AI-related transactions, private equity deployments, and international cross-border deals.
And number 4 is the capital return story. With 300 basis points of excess capital, a $20 billion buyback authorization, and a growing dividend, they're returning significant capital to shareholders.
Finally, international expansion. They're seeing strong M&A advisory flows from Asia-Pacific, particularly Japanese outbound transactions, and continue to grow their wealth management presence in key global markets like Hong Kong, Singapore, and London.
We always cover the risks. What should investors be watching?
The number one risk is valuation. At 3.9 times tangible book, this is not a cheap stock. If earnings disappoint or ROTC compresses, that multiple could contract quickly.
Regulatory risk is always lurking for big banks.
Absolutely. FINRA has been conducting a review of Morgan Stanley's anti-money laundering procedures, covering the period from October 2021 to September 2024. The firm has had historical fines exceeding $35 million in AML penalties. There's also been recent enforcement actions, including a $1.6 million fine for municipal securities failures.
Trading revenue cyclicality is another concern.
Yes. Q3 2025 was exceptional, with equities trading up 35%. But trading is inherently volatile. In low volatility markets or periods of reduced client activity, institutional securities revenue could decline meaningfully.
Interest rates are also a factor.
If rates decline significantly, their net interest margin compresses. A good portion of wealth management economics depends on sweep deposit revenue, which is directly tied to interest rates. Plus, geopolitical uncertainty could slow M&A deal flow and reduce capital markets activity.
All right, Lana, bring it all together for us. What's the verdict?
Morgan Stanley is a best-in-class franchise that has successfully transformed itself from a cyclical trading house into a diversified financial powerhouse anchored by wealth management. The numbers tell the story: $70.6 billion in revenue, 21.6% ROTC, $9.3 trillion in client assets, and strong organic growth.
The thesis really comes down to whether you believe the wealth management flywheel keeps spinning.
Exactly. If net new asset flows remain strong, if the E-Trade and digital assets initiatives drive adoption, and if fee-based revenue continues to grow as a percentage of the mix, then the current premium valuation is justified and there's room for further appreciation.
But if you're looking for a bargain entry point, the stock has had a huge run and is trading near all-time highs relative to tangible book value.
Right? The ideal scenario for a new investor would be a pullback driven by temporary factors, like market-wide risk-off sentiment or a weaker-than-expected quarter in trading. That would provide a better entry into what is fundamentally a high-quality, well-managed company.
That's our deep dive on Morgan Stanley, ticker MS, episode 87 of Charged Alpha.
If you found this valuable, make sure to subscribe wherever you listen to podcasts and leave us a rating. It helps more investors discover Charged Alpha.
And visit chargedalpha.com for our full library of S&P 500 deep dives. We're building the definitive stock encyclopedia, one company at a time.
Every episode is research-backed, and every episode aims to make you a more informed investor.
One final note. This episode was produced with the assistance of artificial intelligence tools for research aggregation and script development. All financial data has been sourced from Morgan Stanley's public filings, earnings reports, and reputable financial databases.
Charged Alpha is for educational and informational purposes only. Nothing in this podcast constitutes financial advice or a recommendation to buy or sell any security. always do your own research and consult with a qualified financial advisor before making investment decisions.
Thanks for listening to Charged Alpha. Until next time, stay informed and stay invested.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.